Options trading is another way for stockholders to invest in the performance of a security, such as a stock or an ETF. By trading options, an stockholder's attempts to capture the up or down movement of a security, while only investing a fraction of the cost it would take to own the asset actual security. For example, consider a stock that's currently trading at $100. If you bought a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from the same jump in the stock price, while only paying a small premium that costs considerably less than the price of owning the stock. The capability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater menace of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option agreement, you're not purchasing the security itself. Instead, you're buying a contract that gives you the right to buy or sell a security at a certain price before a certain date. Consider this example. Presume there's a bakery chain called Heavenly Pies Bakery. Heavenly Pies stock is currently trading at $50 a share. A stockholder believes that the stock price of Heavenly Pies will rise. This stockholder considers taking advantage of this anticipated price movement by buying 100 shares of the stock, but she is concerned about the initial capital requirement. Now let's assume that there's another stockholder. He already owns 100 shares of Heavenly Pies stock and plans to hold on to it for a while. He thinks the stock price will not increase much over the next few months. Both stockholders can utilize a call option. This type of options contract gives the buyer the right to buy shares of Heavenly Pies stock at a set price, called a strike price, at a set time called expiration. In this case, it's $55 per share in 4 weeks' time. Typically, each standard option contract represents 100 shares, so this one contract would give the buyer the right to buy 100 shares of Heavenly Pies stock at $55 per share. The buyer purchases the contract by paying the options premium. The premium or price of the option is determined by several factors, as well as the stock price time until expiration and implied volatility, which is how much the stock is expected to move during the life of the contract. This premium gets credited to the seller of the call option and helps to moderately offset the original purchase price of the stock. For this example, let's assume the total premium is $100. Our buyer pays the $100 and purchases the contract. Now let's examine what could happen to this deal. Suppose our buyer's instincts were right and Heavenly Pies stock is now selling at $60 a share. Consider, the call option gives the buyer the right to purchase shares of this stock for $55 a share. The buyer could exercise the call and purchase 100 shares for $55 each and then sell them at market value for $60 each, making a profit of $5 per share, not including contracts. Because shares of Heavenly Pies have risen by $5, the buyer's contract is essentially worth $500. If our buyer sold her contract, she could potentially make around $400 in profit, the value of her contract minus the $100 premium she originally paid for it, as well as any commissions and fees. While the buyer's investment paid off, things didn't work out as well for the seller. Although he was able to collect $100 for selling the option, he missed out on a portion of the stock's appreciation because he was obligated to sell his stock at $55 per share. Now let's rewind. Suppose the stock moved in the opposite direction and is now selling for $45 a share on the last trading day prior to expiration. The buyer's contract gives her the right to purchase shares of Heavenly Pies for $55 a share. Because no one would want to pay $55 for a stock that's selling at $45 in the open market, the buyer's contract will likely expire worthless. The buyer is now on track to lose 100% of her initial $100 investment plus any trading commissions and fees for the seller. The option expiring worthless is good news. He still owns his shares of stock and made $100 selling the option. Although the value of his shares declined, he was able to keep the option premium less any commissions and fees for selling the option. Keep in mind that this is a simplified example. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the underlying instruments that the contract represents, there are other forces like time decay and implied volatility that influence options prices. While we showed you one example, options can be used in a variety of ways. There are call options which we just saw that can be profitable to own if the price of a stock goes up. And then there are put options which can be profitable to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, stockholders have the potential to make money when the market moves in any direction and create strategies with a variety of risk levels. You've taken the first step in understanding options. You have taken the first steps to understand, but there's much more to learn. Thanks for watching.